This is Satya Pradyuman of Cirrus Research. This quick summary has been recorded for our Espresso, which is a newsletter that summarizes some of our market views. The title, Markets Broaden as Beta Risk Squarely Lodged in Mega Caps. Now, in the last year, we've seen a tremendous amount of volatility, a massive focus on AI investments in the US. Markets have come back nicely from the April 7th bottom. That said, when we look globally, most markets are outperforming the US this year, which is radically different from the prior years. So the question is why? And I think to some degree, what we're beginning to witness is a broadening in terms of adding protection to the portfolio. What I'll walk through are a few observations that I think that make this case. Number one, if we look at high beta in large cap land, those numbers have been very dramatic. We understand that the AI bet, and maybe even some private credit financial firms, those firms have squarely been on a tear. And as a result, the beta position for large cap is now a lot more aggressive than it is for smaller caps. And in fact, when we look back since the April bottom this year, what you'll notice is that small caps and micro caps have now outperformed, and for microcaps, outperformed sharply year to date. And so the question is why? And so to some degree, we could claim that this is all about, taking on more risk. But when we look at the extremes of where high beta is lodged, it's not in where you think it is. It's actually in large mega cap, more specifically maybe AI. When we look at where speculation levels are in the US, we have fairly aggressive readings for our risk appetite model and our crowding model. So both of these elements are signaling sort of top-ish event. Now, bear in mind, these models, they don't necessarily predict what the markets will do. What these models do, though, is that they really reflect the amount of adverse moves you see with some bad piece of news. In other words, if we have weak earnings for very specific companies, if the inflation number spikes, if the dollar continues to weaken, et cetera, if the Fed does not cut rates, one of these events would be an example as to why you get more of an amplified pullback. So that's where this setting is right now. Importantly, as we go into the earnings season, we've said this before, the forecast for earnings have reversed sharply. Now, while the system is actually stable, what we're seeing is the hurdle rates really for success on earnings, both for large and small, but especially for large caps, it's especially aggressive. And then when we look at the global trade, it makes sense. From small to large, we've had a massive value gap over time. This is probably, our data goes back 20, 30 years, and these are fairly extreme moments. But if you take that across and look at cross markets, all the major developed markets, you're witnessing a very similar event. So what could be happening here is, yes, we're going to take more risk, but the fact that overseas markets are outperforming, the fact that smaller firms are now participating, says that investors are now looking high and low. In fact, one additional set of broadening is fits into the AI thesis as well, which is what we're noticing now are in our upstream, downstream bins of AI plays. What you'll notice is that within the downstream bins, both data centers, alternate energy that's nuclear, and even crypto, the AI plays in those are outperforming the upstream play, which is chips. So broadly speaking, investors are looking high and low to diversify, and I believe this is already underway. Take a look at the full report. Thanks.